Welcome to the fascinating world of finance, where the rich have an unexpected love affair with debt. It might seem puzzling at first. After all, isn't debt something to avoid? But hold on, there's more to this story than meets the eye. Let's embark on a journey to uncover why wealthy individuals embrace debt, unlocking the secrets behind their financial success. Get ready to explore the intriguing art of leveraging opportunities and the risks they take to build their fortunes. Get ready to understand why, for the affluent, borrowing becomes a powerful ally on the path to wealth and achievement. Welcome to the captivating allure of strategic borrowing, where dreams are realized and fortunes are made. Wealthy individuals have a different perspective on debt, compared to many poor people. While the poor strive to pay off their debts as quickly as possible, the rich actively seek ways to increase their debt load. This concept may be difficult for the poor to grasp, as they wonder why anyone would willingly take on debt, along with its associated interest. However, rich people utilize debt in various ways. They choose to have mortgages, car loans, and other forms of payments instead of pursuing a debt-free lifestyle, without monthly obligations. This choice may seem puzzling, but it actually offers valuable insights. Most of us have heard about two types of debt: good debt and bad debt. Bad debt refers to money borrowed for liabilities or items that consistently cost money and decrease in value. For example, a car loan is generally considered bad debt because consumers often borrow money to purchase a depreciating asset that incurs monthly expenses. In order to make the payments, they need to work and earn money. On the other hand, good debt involves borrowing money to generate more income. A common example is taking out a mortgage for a rental property, or a loan for a business, that yields more profit than the debt costs. The monthly payments are covered by the income generated by the asset, and even exceed it. Real estate investors are willing to pay interest rates of 5%, 6%, or even 10% on borrowed money because they know it will enable them to earn much higher returns. A real estate professional, for instance, may have a mortgage with an interest rate of 7%, but can potentially achieve a 15 or 30% return on their investment, or personal contribution to the deal. Let's consider the scenario of a restaurant manager who wants to open a new restaurant. It comes as no surprise that the endeavor is highly expensive, requiring funds for rent or purchase, equipment, furniture, food, insurance, and staffing. Saving up such a significant amount of money would take decades, trying to outpace inflation, or they can opt for a business loan and start much sooner. Although they will need to pay interest on the borrowed money, it becomes worthwhile if they are making a profit. Furthermore, the interest paid on debts can often be deducted from taxable income, reducing the overall amount owed in taxes. Did you know that the interest paid on mortgages, student loans, and business loans can be your secret weapon for reducing taxable income? It's true. Let me break it down for you in a way that'll have you nodding with excitement. Imagine someone earns a cool $100,000 annually. Now, they've got $10,000 in tax-deductible interest payments on their plate. But hold on, this doesn't save them a flat $10,000 in taxes. Instead, their taxable income shrinks to a sweet $90,000. They're not just dreaming here, they're paying taxes on the reduced income, and that's a big win. People don't go into debt solely for the purpose of claiming tax deductions on interest, but it serves as an added benefit. You might be thinking, well, no one jumps into debt just for tax benefits. You're absolutely right, but stick around for the extra perks. By cleverly leveraging the bank's money instead of going all in with their own, they can scale their investments faster than lightning. To illustrate, let's say someone has $100,000 to invest in rental property. They have two options: paying cash for a single property worth $100,000, cash on the table, safe but slow, or putting 20% down on 5 separate properties, worth $100,000 each, and financing the rest. Paying cash for one property is the safer choice, but it may take a long time to save up for the next property, even considering the extra cash flow from owning it outright. By utilizing the bank's financing, the investor can leverage their cash and experience appreciation across 5 separate properties. Additionally, they can benefit from tax advantages and see their mortgage balance reduced each year. This ability to scale also applies to other business owners. However, it's essential to note that using other people's money comes with higher risks. Borrowing money means the possibility of encountering difficulties in repayment. In such a scenario, defaulting on loans could result in losing assets. On the other hand, leveraging can lead to exponential returns, surpassing what someone with no debt typically earns. Higher risk entails the potential for higher rewards. When you leverage money, your investment returns are amplified, whether they are negative or positive. This powerful concept isn't just for property moguls, it's also game changer for all business owners too. But, I won't deny it, more power means more risk. Borrowing money can sometimes feel like walking a tightrope. The thought of troubles and debt issues might give you chills. But let me tell you a secret, the potential rewards are as incredible as the risks. When you're savvy enough to leverage money, your investment returns take center stage, they'll shine brighter than a supernova. The sky's the limit, and you'll watch your profits soar like never before. So, embrace the might of other people's money, unlock the door to exponential growth, and step into the world of high-stakes rewards. When things go well, they go exceptionally well, and when things go poorly, they go very badly. This isn't surprising for wealthy individuals, who have mastered the art of balancing risk and reward. When venturing into the world of debt, they avoid borrowing money recklessly for ventures with a high likelihood of failure, and instead seek opportunities at discounted prices. They tread carefully and cleverly seek bargains to minimize their exposure. Enter Dave Ramsey, the financial guru. Dave Ramsey's teachings can be highly effective for the average person striving to build long-term wealth and preserve it. By following his strategies, there is only minimal risk of losses. Nevertheless, the major drawback is that it may take a considerable amount of time to achieve significant financial progress. In fact, following his rules may require a lifetime to amass $1 million portfolio. While Dave Ramsey's advice, such as live on less than you make, is valuable for everyone's financial success, not all affluent individuals adopt all of his recommendations. The wealthy question why they should pay off low-interest debt when they can consistently earn higher returns by investing the money. The saying, "It takes money to make money," holds a lot of truth. Rich individuals have easier access to capital, enabling them to grow their wealth more effortlessly. Having access to debt provides them with the flexibility of having cash on hand, without losing value to inflation by keeping it idle in a savings account. They value lines of credit, as they allow seizing opportunities promptly without the need to sell assets, which could lead to losses or negative tax implications. People with substantial debt often welcome high inflation, since it reduces the value of their debt over time. Inflation provides borrowers the advantage of repaying lenders with money that has a lower value than when it was initially borrowed. In recent years, many individuals opted to borrow money due to the extremely low interest rates, making borrowing almost cost-free. While borrowing money at a 3% interest rate might seem expensive, when inflation is around 8%, the value of debt actually diminishes over time. On the surface, borrowing money appears to be costly, especially with interest paid on long-term loans like a 30-year mortgage or a 6-year car loan, which may seem exorbitant. However, when inflation is taken into account, borrowing money becomes less expensive than it appears. In many loan types, each payment made helps to reduce the outstanding balance. As time passes, the balance decreases until it is eventually paid off, although this may not always be the primary goal. Wealthier individuals consider the principal pay down as an added benefit of borrowing money, akin to icing on the cake. At the start of most loans, such as a home mortgage, the principal is hardly reduced as the majority of the monthly payments go towards interest. Over time, the payoff accelerates, but the principal paydown remains an additional benefit most of the time. However, this benefit pales in comparison to the advantage gained from inflation, shrinking the size of the debt, and the ability to leverage borrowed funds. Using debt is a double-edged sword, and those who are not emotionally equipped to handle it are better off staying debt-free and following the financial strategy popularized by Dave Ramsey. His principles are generally reliable, but it's worth noting that wealthy individuals appreciate debt for the reasons mentioned. Using debt strategically can provide numerous benefits and expedite wealth building. Keep in mind the reasons why successful people embrace borrowing money, and use this information to make better financial decisions suited to your own situation.